Welcome back to the deep dive, where we take all that research, the market data, and the white papers you've shared with us, and really craft a single, clear path to understanding. It's all custom tailored for you.
Right.
And today we're putting on our hard hats. We're going deep into Hedera, which you'll know by its ticker, HBAR.
This one is particularly compelling, I think, because we're staring at a huge contradiction. Our sources are blending this fundamental analysis of what is arguably a superior enterprise-grade technology hash graph with these highly aggressive short-term price targets. And the long-haul forecasts are, well, they're frankly explosive.
Absolutely. So our mission here is really twofold. First, we've got to unpack why HBAR is so often called a sleeping giant in this whole distributed ledger space. We need to look at its unique structure, its, corporate backing.
And the second part.
And second, we'll zero in on what the charts are, well, what they're screaming at us right now. We're talking mass ED, Bollinger Bands, and the very precise signals that suggest a pretty dramatic price move is coming. And soon.
So let's set the stage. As we're here in early December 2025, HBAR is trading right around that 13-cent level. And it is under immense pressure from two completely opposing forces. It's a genuine tug of war.
And on one side of that rope, you've got the broader crypto sentiment, which, let's be honest, is just terrible right now.
Exactly. The fear and greed index is flashing extreme fear. It's at 23. And what that means is investors are just in pure risk-off mode. They're selling assets pretty much indiscriminately, and that's definitely pulling HBAR down.
But the other side of that rope is pulling up. So what is that fundamental bullish signal that's fighting against this market mood?
It's the sheer technical setup. I mean, despite all the bearish sentiment just washing over the market, HBAR's trading indicators are flashing these early but very clear bullish divergence signals. So what this means for you is that HBAR is really fighting a battle between its utility and adoption, which are strong.
And growing.
And growing, yes, against that broad crypto market weakness. You can almost feel the tension.
Okay, let's unpack that foundational difference then. When we talk about Hedera, we are not talking about a traditional blockchain. The core tech is Hashgraph. For anyone just catching up, what is that fundamental architectural difference?
Well, the difference is structural, and it's absolutely critical for enterprise use. You see, traditional blockchains, they operate sequentially. Blocks transactions are verified, added one after another in a line.
So you have to wait in line, like people queuing up single file outside a venue?
Precisely, a perfect analogy. Hashgraph, on the other hand, uses a structure called a directed acyclic graph, or DAG. So instead of a single chain, you have transactions organized non-linearly. It's more like a mesh or a web. It allows multiple transactions to be recorded at the same time across different paths. It just vastly increases the potential throughput.
So the core difference isn't just about speed, it's the entire architecture. And this is what allows for its consensus mechanism, right? The gossip protocol. How does that actually work in, plain English?
Think of it like news spreading in a huge office, but with mathematical certainty. In a regular blockchain, everyone has to wait for one central message, from the miner or validator to announce the next block.
Okay.
With the gossip protocol, the second a node gets a transaction, it instantly gossips that information to its neighbors, and then those neighbors gossip it to their neighbors.
So the information just spreads exponentially.
Correct. And this is the critical part. When the nodes gossip, they include all the information they know about past communications, which creates this comprehensive hash. Consensus is reached incredibly fast because every node knows who else knows the transaction and exactly when they knew it.
So you're getting near instant validation without waiting for a whole new block to be created.
You've got it. And we should probably mention, this algorithm, it was developed by an American mathematician, Lehman Baird. It's patented and owned by a company called Swirls, which gives the tech a really strong, kind of protected commercial foundation.
It does, and that patent, that unique structure, that's what translates into the advantages that attract these massive corporations.
The metrics are industry-leading. For speed, Hedera is designed to handle over 10,000 transactions per second. With confirmation finality, and that means the transaction is mathematically guaranteed in just 3 to 5 seconds.
That is just lightning fast compared to most legacy systems, though our sources do add some important nuance there.
They do.
Current throughput for more complex things like smart contracts or file services, it's closer to 10 TPS. But the point is the architecture means those higher speeds are a genuine future potential.
That's a key nuance. But the metric that really closes the deal for massive enterprise clients is security. Hashgraph achieves something called asynchronous Byzantine fault tolerance, or ABFT.
That is a mouthful. Why should a major company like Google or IBM even care about something called ABFT?
Because it's the highest possible standard for distributed system security. In a nutshell, it means the network is mathematically guaranteed to reach consensus, even if up to a third of the nodes are malicious or just offline.
Even if they're actively trying to block things?
Even if they're actively trying to impede or censor transactions. So if you're a multi-billion-dollar corporation and you're migrating mission-critical data, like, say, land registry records, you need absolute mathematical certainty that data cannot be secretly corrupted or changed. That's what ABFT gives you.
It removes the biggest liability, fear.
Exactly. Then you layer on top the low predictable cost, we're talking fixed fees as low as 1/100 of a cent, and this explicit commitment to being a carbon negative network. It's a perfect package for ESG compliance.
That ESG appeal is huge for global companies, and that takes us right to the other major advantage Hedera has, its governance model. This isn't decentralized in the, let's say, traditional crypto sense. It's governed by a boardroom of global giants.
That's right. It's backed by the Hedera Governing Council, up to 39 leading global companies. And the list is, well, it's truly impressive. Our sources highlight Google Cloud, IBM, Boeing, Deutsche Telekom, LG Electronics.
But isn't there a risk there? I mean, relying on 39 corporate giants, doesn't that compromise the network's decentralization or, I don't know, make it prone to regulatory capture?
That is the core philosophical debate around Hedera. And it's exactly why the sources stress the council structure. The argument for Hedera is that true decentralization isn't just about anonymous nodes, it's about institutional diversity.
Okay.
Council members serve defined 3-year terms. They're limited to 2 consecutive terms. And they are intentionally diverse. Geography, industry. You've got telecom, aerospace, tech, finance.
So the idea is that the network maintains stability and decentralization over time, not just right now. It's corporate governance applied to DLT.
Correct. What these giants do is run a validation node, they influence a roadmap, and they collaboratively manage the treasury. And that stability is what makes the utility case so compelling.
This is where we shift from theory to something tangible. Let's connect this institutional backing to the real-world adoption that we can actually see today.
We are seeing enterprise-grade utility across some really critical sectors. Let's take 2 key examples. First, the public sector. Just this month, December 2025, Hedera secured a partnership with Georgia's Ministry of Justice to migrate property records onto the network. This is massive.
And we have seen the price react to news like this before.
Oh, absolutely. The sources remind us that a similar deal back in 2025, it was with Dubai's land registry. It triggered an immediate 22% HBAR price rally. These public sector deployments, they're the ultimate validation of Hedera's model.
So the argument is that the adoption is happening, but the price hasn't reacted yet because of the implementation lag. Migrating a national database takes time. The sources cite what, a 12 to 18-month timeline?
Right, and that lag creates the opportunity. But the adoption is broader than just government records. You've got South Korea's Shinhan Bank using Hedera for international remittance. Avery Dennison is using it for supply chain authentication. LG Art Lab integrated it for its NFT marketplace. It's hard to dismiss the real-world application here.
But utility alone doesn't guarantee price performance, right? Especially with all this regulatory uncertainty hanging over the entire crypto space. We have to talk about the ETF.
This is the single biggest near-term institutional catalyst, or risk. The SEC is reviewing Canary Capital's spot HBAR ETF. That decision is expected in the first quarter of 2026. Grayscale has a filing pending too.
And if it's approved...
If approved, the assumption is that billions in institutional capital could just flow in, similar to what we've seen with other crypto ETPs. It would be a powerful fundamental shift.
But the risk of rejection is just as powerful on the downside.
It is. We saw a 47% drop in volume just after a market-wide regulatory scare recently. The market is highly sensitive, so the price is trapped between that promise of utility and the immediate threat of a regulatory decision.
So that's the long-term case, but you mentioned this incredible short-term signal. What are the charts telling us right now? We're focusing on a pretty aggressive forecast, targeting 16 cents within 1 to 2 weeks. That's a 23% upside from where we are.
It is aggressive, especially with the extreme fear in the market. But the indicators are converging beautifully. This forecast is really based on the idea that the short-term selling exhaustion is complete and a mean reversion bounce is, well, imminent.
Okay, let's slow down and break down the specifics. Which technical indicators are suggesting this bounce is ready to go?
First, you look at the MACD, the moving average convergence divergence. It's a momentum indicator. And the MACD histogram has just turned positive. It's reading 0.00005.
So even though the price has been trending down, the momentum underneath is actually starting to build. That's the definition of divergence.
Exactly. The sellers are losing conviction. Next, we look at the Bollinger Bands. They measure volatility. HBAR is trading right at the lower band, with the Portia B position at 0.1319.
And what does that usually imply in terms of market dynamics?
Well, when a token touches that outer edge, it's a classic sign that the recent selling was statistically overdone. Traders will often expect a snapback, a bounce back toward that middle line, usually within a few trading sessions.
So we have momentum shifting with the MACD and the price being stretched too far down according to the Bollinger Bands. What does the third major indicator, the RSI, tell us?
The relative strength index is sitting at 38.04. Now, that's technically neutral, but it's getting close to oversold, which is usually below 30. But crucially, the combination of a positive MACD and an RSI just above oversold creates what analysts call a classic bullish divergence pattern. It's a textbook setup.
This sounds like a high-risk, high-reward trade, though, given the market environment. For anyone looking at this short-term bounce, what are the precise levels and the strategy from the sources?
The immediate target is 16 cents. That price aligns perfectly with the 50-day simple moving average, so it's the next major resistance level the price needs to break.
And the risk. What kills this whole trade idea?
The critical support level is 12 cents, which also happens to be the 52-week low. If HBAR breaks and closes below that, the technical thesis is pretty much invalidated. So the recommended strategy is a tight entry, right around the current 13.5 cent range, with a very strict stop loss set just below that support at $1.19.
And to confirm this is actually happening, we need to see specific movements, right? It can't just touch the resistance line.
Correct. We need confirmation. That means sustained trading above the Bollinger Band middle line, which is sitting around 14 cents right now. And the RSI needs to move decisively above 45 to show that real buying strength is back. Without those two, it's all still just speculative.
That is extremely detailed. So let's zoom out now. If HBAR is this sleeping giant, what do the multi-decade algorithmic models say for the long-haul investor?
Well, the models are projecting some truly monumental growth, fueled by that compounding utility we talked about. And we have to state this clearly. These are projections. They're subject to extreme volatility, but the average forecast, they paint a picture of just massive potential.
Give us the headlines. What do the models say about the end of the decade and beyond?
By the end of 2026, the average price is forecast to stabilize around 18 cents. Steady growth. But by the end of 2030, the average price jumps significantly to 86 cents. And here's where the numbers get, well, kind of crazy. The average price is projected at $68.64 by the end of 2040.
Wow.
And it peaks at an average prediction of $106.10 by the end of 2050.
Those are staggering numbers. And they rely entirely on that utility finally catching up to the technology. What specific catalysts are baked into those forecasts?
They rely on a few main things. First, the durability of that governing council, ensuring stability and regulatory confidence. Second, the ESG focus, which makes it a natural choice for certain institutional funds. But mostly, they rely on continued sticky adoption, the kind you see with national real estate databases and global finance players.
So what are the biggest risks that could derail those forecasts and keep the price down?
Primarily extrinsic risks. I mean, if Bitcoin dominance remains high, or if the whole crypto market enters another prolonged bear cycle, capital just drains away from altcoins like HBAR, regardless of their utility.
And the long timelines are still a challenge.
They are. 12 to 18 months for a full migration means utility doesn't translate into immediate token demand, which can lead to investor fatigue. And then there's the final point. Despite being technologically superior in many ways since its release in 2017, Hedera still struggles to find that widespread retail popularity, the hype of its competitors.
And that's the heart of the HBAR paradox. You have this superior enterprise-backed tech contrasting so sharply with market volatility and the challenge of converting complex utility into, visible adoption.
Right.
So the core takeaways for you are clear. The network's advantage is its speed and security, backed by major corporations. And right now, that superiority is colliding with market fear, creating technical signals that point to a potential short-term target of 16 cents.
And a crucial reminder for everyone. These are technical analyses and projections. The crypto market is inherently extremely volatile. You must always approach these assets with caution, do your own research, and understand the significant risks involved.
For sure.
This has been a fascinating look behind the curtain of an enterprise giant trying to navigate a turbulent retail market. Thank you for guiding us through that.
My pleasure. And here's a final provocative thought for you to consider as you wrap this all up. Hedera's model, it relies on a fixed governing council of global corporate giants to ensure stability. Now, given these council members serve defined terms and can step down, does this structured corporate governance model ultimately offer more confidence for long-term, multi-decade growth, which the models clearly predict, than the more fully decentralized, community-led structures of traditional blockchains? Something to think about.